Hello guys, and welcome to lesson number 6 of this course, where we're going to be talking about your first strategy. So this strategy is simple yet effective, and it works on all time frames, meaning you can find this setup happening on the daily, on the 4-hourly, on the hourly, 15-minute, 5-minute, yearly, 6 months. You'll find it in all time frames. It works for everything. And these are the rules to the strategy. The first thing is to determine the directional bias, and this is a key point. You need to be able to know where is the bias going. Is price going higher? Is price going lower? Because if you think about it, this is how you're gonna base your trade off of. If you think price is gonna go higher, you're going to be looking for a bullish setup, not a bearish one, because you think price is gonna go higher. But if you think price is going higher and you're looking for bullish setups, but you have the bias wrong, you are gonna get taken out. And that doesn't mean that the strategy does not work. It just means that your bias is wrong. Secondly, you'd want to see a run on liquidity going against your bias. So same thing, let's say you have a bullish bias. You would want to see price take out short-term sell-side liquidity first before actually creating the setup. So after price took out the sell side liquidity, you're gonna expect to see a displacement taking out a key level in favor of your bias. And what that means is, same, we're bullish, price will make a run on the short-term sell stops before a displacement higher. Displacement taking out the key level, and that displacement gives us our bullish shift in market structure and our confirmation that the market wants to reprice higher. Typically around 2 to 6 a.m. New York time is where you would find this displacement happening. Then after that displacement, you'd expect a retracement, so price to trade back down into a discount of the displacement range. And you can expect this to happen between 7 to 10 a.m. New York time. Then once price is at a level of extra confluence, such as the fair value gap, break or block, or an order block, that's where you would open the position. That's where you'll actually enter when price is at that level of confluence. You'll keep the stop loss at the bottom of the range. Then your first target would be the top of the range or the bottom of the range, depending if you're bullish or bearish. And the next target would be a recent pool of liquidity resting nearby. So, directional bias. And as I said, it is by far the most important part of any trader skill set. If you're able to understand the bias consistently and frequently, everything else will just fall into play. And you already know this because of the bias lesson. We use a top-down approach, marking out key levels of liquidity and imbalances to figure out where price is drawing to. And once you have a clear bias in where the market is going, you begin to drop into the lower time frames to find your point of entry. And if you don't have a clear bias, it doesn't mean you just keep dropping to lower time frames until you see something. You simply just be patient and wait until a clear bias has formed. Then the run on liquidity. And let's say the bias is bullish and you're scouting for bullish setup. It's important to see a run on liquidity going against your bias. And in this case, you want to see a run on sell side liquidity, and that is the manipulation that is needed to take place to bring in liquidity into the market. So the reason we would want to see price go against our bias, taking out maybe equal lows if you're bullish, is because that's price manipulating the market. That's actually where the traders will get trapped short, but we know that the price is going higher. So once the trap has been set, we can expect price to trade according to the bias. And obviously it's opposite. So if your bias is bearish, it's key to make sure that there's a run on the buy side liquidity, as that's the manipulation which brings the liquidity into the marketplace. Next, we want to see a displacement. So once the liquidity has been set into the market, you would expect a displacement taking out a key level in favor of your bias. Once this is seen, that's your confirmation that your bias is correct. So let's look at this example to the left. We can assume that the market bias is bearish, and we see that there's the resting buy stops above here. Price would trade higher, take out the buy side liquidity for trading lower pretty strongly, and then retracing back up to fill the gap at the order block level for a displacement, taking out this key level. And this would also count as a displacement, taking out this key level. And then on the flip side, we have the sell side liquidity here. Price trades down, taking the sell side liquidity before this bullish displacement, which confirms our bullish shift in market structure. It confirms that the market really is bullish. Then a retracement. So after this displacement, it doesn't mean you enter at the high here or the low here. You need to be patient and you need to wait for a retracement into the discount or the premium of the trading range. So if you're bullish, like in this example, you'd want to see price below this 50% line before trading higher. And if we're bearish, we'd expect price to retrace back up into the premium, which is above the 50% line, before we go short. And then for the entry, to get the most optimal trade entry, and that's what we're looking for, the most optimal trade entry, not the perfect trade entry, because if you chase perfection in trading, you're not gonna make it very far. There's no trade is gonna be perfect. It's very rare to have a perfect trade where you had no pips in drawdown and you closed exactly at the high or the low. It's very rare to see this. You just want to capture the bulk of the move. The majority of the move, you want to capture it. So we would like to be in the retracement of the trend and either in a premium or a discount of the range, coupled with our confluence points such as an FFG, which is a fair value gap, a breaker block, or an order block. Meaning the optimal trade entry, if we were bullish, is price retracing into a bullish displacement. Then we would wait until we reach the discount of the range and look for any of our confluence points before going long. And stop loss is to be kept below the range's swing low. And the opposite, the optimal entry if we're bearish, is price retracing into a bearish displacement. We would wait until we reach the premium of the range and look for any of our confluence points before going short. Same stop loss is to be kept below the range's swing high. So everything that is happening in this setup, you have been taught in this course. Each lesson is a key concept which helps you understand the markets and is how you will be able to actually find entry points and enter in positions. And this is the bullish entry structure. So you see here is that we have our form of liquidity. Price will go up, trade below this liquidity, and our underlying bias is bullish. So once we see price trade lower below this liquidity, we can expect that there are traders trapped short. Once there are traders trapped short, price is gonna trade higher, taking out this key level here, which is our displacement, before price retraces back to the discount of the range and at the breaker block over here before price trading higher. This trading setup follows a simple set of rules, and this setup happens 2 to 3 times a week across multiple pairs. First, I run on the sell side liquidity here before a displacement, and with that confirms that our bias is correct. Then a retracement of the displacement, and our rules for entry is price needs to be at a discount and have one of the 3 extra confluences, either price retrace to fill a fair value gap, or price at a breaker level, or price went to a bullish order block. But price has to be below a 50% level and in confluence with the fair value gap, the breaker, or the order block before you can go long. And let's see the bearish entry structure. So first you'd expect a run on the buy side liquidity here, and you see it happening here. Then a displacement lower, then price then you'd wait for price to retrace back up into the retracement above the 50% level, because that's our area of discount over here, and we have extra confluence with price at the breaker before trading lower. Let me actually go into the charts and show you an example of this. So as we see here, we have Euro USD and this move over here. So first thing you do is do a top-down approach, right? Well, we already know that our bias is bullish because of this strong displacement here, and price willingly wants to trade higher. So what do we notice here? At 2:45, 3 a.m. New York time, we've seen that price traded below these equal lows, taking out the liquidity. Now once we've seen this, we can expect price to trade higher, taking out this swing high here, this key level. As you can see, price did exactly that. Price traded higher, and look at the times it traded higher. From 4 till 7. Then at 7 o'clock, price had a retracement, filling these gaps at our breaker block level. So now there's two confluences. There's the gaps, the breaker blocks, and let's see if price is at the range. So check from this swing low to this swing high, we'd get our bullish trading range. As you can see, price went to below the 50%, which is our discount in the marketplace, before trading higher, with the first target being this swing high here. As you can see, price traded all the way up here, almost 100 pips, probably to a key point in price. And let's check. Price traded up to where? Taking out these bodies here. And that's why price went all the way up there. So let me just go back to this example quickly. And that's our bullish setup. Well, let me actually draw it for you to explain. So the underlying bias is bullish. First thing we would want to see is price trade below equal lows or a swing low, taking out the short-term sell side liquidity which is resting below it. The reason we want to see this is because that's the manipulation that the market does to get liquidity in the marketplace. Once we've seen that run on liquidity, you would expect to see a displacement taking out a key high. Once price takes out the key high and begins to retrace, you would mark out the trading range. And wait for price to retrace below the 50% level. And the reason we want to see it below the 50% level is because that's the discount of the range. Now when price is at the discount of the range, coupled with our bias being correct, and has extra confluence, due to order block, breaker block, or a gap, fair value gap, then we would enter long, keeping our stop loss below that range low. So this is really what we're trying to see. Point of liquidity here. Price goes, trades below this liquidity, right? And that's our manipulation. So let's do it step by step. We see sell stops here. Underlying bias is bullish. That's the key thing. See, manipulation over here by price taking out the liquidity. Then we want to see a displacement above this high, because that displacement gives us our shift in market structure bullish. Then from this displacement we'd want to see a retracement to the 50% level. So we want to see a retracement at least to below this level here. And when we look at this part and we see maybe a gap, that would be our time to enter long, keeping our stop loss below the low of the swing low of the range. First target would be above this high, then you'd look for resting buy side liquidity to the left of the chart and target the lowest one after this high. So if there was, if it looked like this, so the market looked like before, and you seen price take out this high, you wouldn't close the whole position straight away. You might take a bit off, but your next target would be for price to trade above this high. So it will look something like this. Price will go up of this high, retrace before going up again, taking out this high, and that's where you would close your position. So this is basically the structure of the setup. First thing you need to understand is that your bias, making sure that you are in line with the bias. Then once you're in line with the bias, you would go to maybe the 15-minute time frame and look for a run on the sell side liquidity, because that's our manipulation. That's how the market is getting money into the marketplace. After the manipulation, you want to see a displacement, giving us our bullish shift in market structure and confirming that we are correct, that our bias is correct. Then you would want to see price trade below the range, trade below the 50% line of the range at a discount before trading higher, taking out this high first before the resting buy stops above it. And that's the bullish setup. So let me show you now an example of the bearish setup. And here it is. Same thing, as you can see, underlying bias is bearish because of this displacement here, telling us that we should look for price to go lower. As you can see over the day, there is buy stops over here. Price would trade above these buy stops. That's our manipulation. Before price trades lower, goes back up to fill the gap, to fill these order blocks, and to go to these order blocks before trading lower again. But if you look at the time, if you look down here at the time, this happened during London session, meaning at 4 a.m. So if you are awake that early and you would want to take in the trade, you could, because this trade is universal. But let's say you woke up to trade New York time, so you missed this. All of this happened overnight. And once you've seen this displacement, price go to fill the gaps before trading lower, your bias is still bearish because there's no reason to think it's bullish. So you can see here at 7 a.m. all the way here at the bottom, you see 7 a.m. price retraces back up, and at 8:45 has a key high here. So you would drag the range from this high to this low, and you would wait for price to trade up into the premium, and the premium is above the 50% line of your fib. Price trades into the premium. As you can see, there are two confluences in this setup. I'm gonna give you a second and hopefully you can tell me what they are. Okay, I hope you got that right. That there's a gap and there's an order block. So you see there's a gap here because the bottom wick of the first candle and the top wick of the third candle create a gap here in the market. Price trades to fill the gap. Look, reacts to this bearish order block here. We would keep our stop loss above this high or this high because it's resting nearby, depending on what you can risk. Have a short position at this order block level. Stop loss would be here. Expect the first target to be this low or this low. Then once price took that out, you would want to see price take out a nearby swing low. There isn't in this example, but it's alright. That's the concept basically. So let's go back and let me make sure you understand it. So when our underlying bias is bearish, you would first want to see price trade above buy stops, taking out the resting liquidity above it. Once price took out that liquidity, you would want to see a move to see a bearish displacement taking out a key low. Once we've seen that displacement, we would mark the range, from each swing point, so swing high to the swing low, and wait for price to retrace above the 50% level, as that is our premium. So once price is at that premium, coupled with the bias being bearish, and that was confirmed to us due to the displacement taking out that key level, so we can be 100% sure. So once price is at that premium, coupled with the bias being bearish, and there is a confluence point such as a breaker block, we would go short, keeping our stop loss at the top of the range and can expect first take profit at the low of the range. And this is how the structure is gonna look like. So when we're bearish, we want to see price trade over this liquidity point here. Be our buy stops, because when price trades above that buy side liquidity, that is the manipulation, and market is bringing in liquidity. So once our market brought in liquidity, the price does not want to stay at a high price because we're bearish. So the next thing that price is gonna do is trade lower with the displacement, taking out this key swing low. So this is our displacement, which confirms to us that market is bearish. Then that doesn't mean we rush to enter short here. No, we have to be patient and wait for a retracement above the 50% level, above this here, because above that level is our premium. So we'd wait for price to retrace into our premium and then look into this displacement here. Is there any confluence points we would like to see? Price at the premium coupled with a confluence point before going short. So if the market bias is bearish, if we seen price take out liquidity, if we seen a displacement after, then a retracement of that initial displacement into a premium and coupled with a confluence point, then and only then can we go short. And the opposite if bullish, obviously. So if you're bullish, what you would like to see is price taking out short-term sell side liquidity before a displacement higher. Then after that displacement higher, we'd want to see a retracement into the discount of that displacement range. And once price is at that discount of that range, we'd look to the left of the chart. So we'd look at the displacement and see if there are any gaps, order blocks or breaker blocks, which can add to our trade ID that the market is bullish. That's all we're looking for. We're looking for certain signs and signals which can give us a better chance in actually making money with the trade and being correct. So that's your universal trade setup. And as I said before, you'll find on the hourly, 4 hourly, daily. Look right here. Let's go on the 4 hourly. And let me find you an example. Alright, here's an example. It's the same example, just on the 4 hourly. You see gaps, price retraced, order block for trading higher, targeting this. On the 4 hourly, it will take more time to form, obviously. But if you find it on the 4 hourly or the daily and you get it right, then you're in for a lot of money. Like, look at this example right here. Same thing that we're seeing all the time. We'll see price trade higher, underlying bias is bullish, then a retracement filling these gaps, price going to the order block level before trading higher, taking this high out before taking this high out. And that's how the bullish setup would look like. And yeah, that's your trading setup, and I hope you've learned a lot this lesson.